Hello and welcome to today's off the road session. That's me. Don't need to know much about me. We're going to talk about central retirement propositions or CRPs today, but we'll throw a few other little bits and pieces in along the way. Just before we get going, a little bit of admin. Who's this for? It's for financial planners, advisors, and paraplanners. If you're not one of those and you're on this conference, by all means stick around, but you're probably going to find it really boring. And probably if you're an advisor or paraplanner, you'll probably still find it really boring. Anyway, we're going to talk about CRPs in the main today. But before we get into that, you may recall the RDR FAMR final report came out from the FCA just before Christmas. So wouldn't be surprised if you did miss that. It came out about the second week in December. So we'll just do a few bits on that. And just before we get into this, again, as a little bit of admin, if you're watching this, by all means, go to full screen. There's a couple of charts and graphs along the way, and you'll see them better if you're in full screen mode. So without further ado, let's get started. Like I said, just a quick word on the report that came out from the FCA just before Christmas on the retail distribution review and the financial advice market review. This has been going on for some time now. It started in 2015. We've had some interim reports along the way. The final report came out just before Christmas. It's about a 70-page report, and I'll summarise for you, or I'll take what I think are the three big takeaways from this. The real thrust of this report was, as a consequence of RDR, which undoubtedly increased the professionalism within our industry and streamlined and helped people to really understand what it was they were paying for, put the advisor front and centre of the whole advice relationship. It caused some unintended consequences, the main one being for people of a certain size of portfolio, probably less than 100, between 10 and 100,000 pounds, who probably would have taken financial advice in the past because they thought it was free. Those people are no longer really being served by the marketplace. A couple of years ago, the FCA decided that we'll call them robo-advisors. So robo-advisors were going to be the solution for these people who fell into that kind of no man's land. And that's really just not been the case. We've seen robo-advisors come and go in the UK. There's a couple of them who have got to what would be considered critical mass. Nutmeg would be the obvious example there. But of course, if you spent nearly £30 million on advertising over a number of years, you'd probably expect to have amassed more than a couple of billion of assets under management. And others who have tried to break into that marketplace have come and gone. The FCA like the idea of automated advice. The reason they like it is for those people with those sums of assets. The all-in cost of advice platform plus the investment solution comes in for automated advice at around 0.8% on average for the solutions that are out there. And that's in contrast to the all-in cost of advice platform investment solution, which on average in the UK for a holistic, what we would call a full fast advice process, that these days comes in at around 1.9%. And you have your own figure of what your investment solution plus advice and platform comes in. But that's a reasonable benchmark. The market is now sub 2% world. That hasn't really worked. The automated advice as a whole has attracted about 3.5 billion of assets, and it's a much bigger problem that in the view of the FCA. And so they really want to try and take this forward by encouraging other solutions other than just robo-advice. And the two solutions they've landed upon, depending on what side of the fence, I guess, you're coming from, is if you've never given advice before, and that they would include, investment platforms like YouInvest or Hargreaves Lansdown, for example. They're trying to nudge people, organisations like that, in the direction of what they call tailored advice. So it's still tailored guidance. So it's still not advice, but it's a little bit more bespoke for the person that you've got in front of you. So they want to go away from just carte blanche, white labeled solutions to something a bit more tailored. The likelihood of that happening is pretty slim. given the boundary between guidance and advice is still really poorly defined. And if you're coming from your side of the fence, which is the advice side, they're trying to nudge you in the direction of more simplified advice. We're all familiar with, that there are different types of people who will take advice, as we'll talk about in a moment, as people get later into life and start to go into, retirement and drawdown solutions, things become a lot more complex. And therefore, the value of advice is eminently valuable. The FCA seem to be suggesting that, for people starting their accumulation journeys in their late 20s, early 30s, it might be possible to do a one and done piece of advice on a more simple basis, and therefore cut out the ongoing annual charges. And again, I think that's probably wishful thinking on behalf of the FCA. Why on earth would you, as an advisor, advise a client to take a one and done piece of advice and come back in 10 years' time, as opposed to nurturing your ongoing relationship? And the final thing that came out of this report was they concluded, this is the FCA, that is, they concluded that despite the fact there are almost 30,000 financial planners and financial advisors in the UK operating from around 20,000 different firms, they decided that this was a non-competitive market. And they used exactly the same tools they used on the asset management industry in 2016, which is, despite the fact there are numerous independent firms, they allude to the fact that the evidence of price clustering, i.e. there are only a certain number of price points in our industry, they use that as evidence of almost kind of unbiased collusion amongst the participants. And the price clusters that they saw in the advice world were 0.5%, 0.75%, and 1%. And practically no other price points were available. You'll know what your own practice is and where you sit on that spectrum. I don't think the FCA are going to go down the lines of price controls. It's certainly not what they went down in terms of asset management when they saw similar evidence. But what they did do at asset management, and therefore I think you can expect to see it in the advice world going forward, is there will be much more onus upon you as an advisor to demonstrate the value that you are giving for the price point that you're offering. And the throwaway comment that the FCA put within the report is, despite the fact that they could see advisors offering ongoing advice at 0.5, 0.75 and 1%, in their opinion, they couldn't see any real discernible difference between the level of service offered for people offering 0.5% or people at the other end of the spectrum offering 1%. So just expect more onus upon you as an advisor to demonstrate the value that you offer the clients. I don't think they'll go down the line of price controls. It's not what they went down on asset management, but something to be very much aware of. And indeed, if you want to put in the feedback to today's presentation, if it's a session that you'd like us to delve a little deeper on the RDR and FAMR final report, we'd be more than happy to do that. Anyway, we didn't come on to talk about advisors or RDR. We come on to talk about these people, old people. They're your clients. And you absolutely ought to love these people. You ought to love these people because, particularly the more wealthy elderly people, they are the people who will nourish your business not only today but well into the future. Because whilst there's lots of them on this slide, there's going to be lots of them in the future as well. And just kind of we can demonstrate that. This is all in the context, of course, of why you would have a centralised retirement proposition. What I'm going to do in the next couple of minutes is help you build a case of why you would want a CRP within your practice if indeed you don't have a CRP within your advice practice at the moment. And first and foremost is it's a growing market. So here we are right now in 2020. There are just under 13 million adults in the UK aged 65 and over. This is a long-term secular growth market. The great thing about population projections are they're very, very easy to make. If you want to take a good guess of how many people will be over the age of 65 in 60 years' time, a good place to start is go and count how many people are over the age of 5 today. very easy to make these population projections. And so whilst there will be a bit of variability on these numbers, you can be reasonably assured that over the next 25 to 30 years, and they're the timeframes we'll be looking at in today's presentation, over the next 25 to 30 years, there will be a secular growth in the number of people aged over 65 and over within the UK. And the great thing about that is these people are more predisposed to take financial advice. So there's going to be lots of them. And as they become 65 and over, they will be more predisposed to take financial advice. This exhibit here is from the FCA's Financial Lives Survey, conducted last in 2017. They split the adults in the UK, of which there are just over 50 million of them. They split the adults in the UK into 4 distinct groups. The group that you're interested in is Group 1. They are the people who say that they took financial advice in the last 12 months. The last data that we've shown on that was in 2019, 4 million people took advice. 2018, it was 3.2 million people. And every time the FCA do this survey, it's somewhere between 3.2 and 4 million people, 3.5 being the average. So 3.5 million people on average are taking financial advice in the UK, which is great news for you because there's only about 30,000 of you, which means that on average, you've all got about 100 clients that you can get in a purely, wholly distributed market. You will all get 100 clients. So, if you are new to this industry, you're just starting off, you're building up your client base. Don't worry about it. In 5 years' time, you'll probably have in excess of 100 clients. And as I've just showed on the previous slide, the number of people over the age of 65 is only going to increase. So these are your clients. They're more predisposed to take financial advice. And the reason they're going to take financial advice is as you get older, particularly as you come to the point of retirement, your financial situation just becomes increasingly more complicated, and therefore you're more likely to seek out professional advice. The survey we did in 2018, we asked all of the advisors who came to our on the road sessions, what proportion of your clients have already retired? You can see from this, almost half of the advice practices that we asked told us that more than half of their clients had already retired. And so we found it was really interesting then, given that that's the makeup of your audience, we found it really interesting that actually we asked a question before this, which was, do you have a centralised investment proposition? And the numbers there were 9 out of 10 people had a centralised investment proposition. But when we asked the follow-up question, do you have a centralised retirement proposition, a standardised way of managing client portfolios and approaching client portfolios for people who are already in retirement, we found it really interesting that it was only 3 in 10 of advisors we asked had a standardised centralised retirement proposition in place. Now, we did that survey in 2018. I've seen some more recent up-to-date work from the Just Group. They suggest that the CRPs have got a bit more penetration since, but it's still only 4 in 10. So just over 40% of advisors in the UK have a centralised retirement proposition. And given that most of your clients are probably retired, there's a business case for having a CRP in place. And if you want another reason for having a CRP in place, cast your mind back to January 2020, pre-COVID world, so a world which probably feels a little bit strange and foreign in today's climate. But this hasn't gone away. You will have received, if you were the director of the advice practice that you're working within, you will have received a letter like this. And it starts with the FCA's logo, front and centre, and then it also is directed with the nice welcome opening line, "Dear CEO or Director." Not what you want to see from an FCA letter. It goes on to talk about financial advice and some of the priorities that the FCA are setting. And in their list of priorities, as at January 2020, you can appreciate while this will have slipped a little during COVID, but as we come out of the COVID environment, they will go back to their list of priorities. And on their list of priorities is assessing suitability, we did the FCA did the original suitability review, and it was the original suitability review was the stuff that you know and love Rory Percival for. So Rory was in charge of the original assessing suitability review, started in 2010. The upshot of suitability 1 was the dawn of centralised investment propositions. Now, assessing suitability 2, you can see are highlighting, which is the focus is on consumers, customers who are taking income in retirement. And so when the assessing suitability 2 review is ultimately complete, we can pretty much cast our minds forwards and take a view that there will be an increasing focus on taking income in retirement. And as a consequence of that, I wouldn't be surprised if the FCA give you the nudge through guidance notes, etc., to have a centralised retirement proposition in place. So there's a secular growth case for this. There's a business case for this because some of your competitors are not doing it. There's a there's a regulatory business case for this. You put all of this together. Really, I would ask the question, why would you not have a centralised retirement proposition, given that these are your customers, these are the people that you're looking to serve? Why not have a more standardised approach to how you manage their investments during retirement? Now, in your CIP, you'll have all of the bells and whistles that I know you'll have in your CRPs. I don't intend to cover them here today. But if you're now developing your centralised retirement proposition, your CRP, there's a couple of other things that you'll want to consider in the formulation of your investment strategies, how you communicate with your clients, how you document the whole process. And I think some of them I put up on this slide here. Obviously, when people go into retirement, their earnings flexibility is significantly different from when they were actually earning income from employment. So in a retirement world, people don't have the same earnings flexibility that they will have had in a previous life. Their capacity for loss will have changed. And the area I will focus on a little bit today is you'll really want to zone in on their spending patterns. In a accumulation mode, when the questions you will ask about spending will run along the lines of, well, how much money do you earn at the moment? How much money do you spend? And that will probably be about the extent of it. How much money do you spend? You want to know the gap between how much you earn, how much you spend, because that gives you an idea of what the client's available savings rate is. And it's those savings which they will accumulate over a long period of time in order to build a pension pot. When you go into decumulation mode, because of the loss of earnings flexibility, you'll really want to zone in on the spending patterns. It won't be good enough just to ask how much do you spend. You will have to ask follow-on questions and on what do you spend your money. And let's do some analysis on what you're spending your money on so that we can make better financial plans for you. And other things to take into account as people get older, their cognitive ability will start to diminish. Now, of course, most people at the age of 60, 65 will still be in rude health. But as you get into 75 and 85, cognitive ability will indeed decrease over time, you would expect. And therefore, you need to build some of those behavioral cues into the process as well. But the single biggest thing you need to consider when you're taking a client through a decumulation phase of their investment journey is they've now just assumed a risk they've never had in their lives before. They've got a pot of money and they need that pot of money to last them beyond their foreseeable life. You've just introduced longevity risk into the financial situation. Now, longevity risk has always been there. It's always been there in society. But longevity risk was always pre-pension freedoms, was always largely pooled across society using life assurance companies. So the risk always existed, but it was managed across society by pooling the risk in a life assurance company who in turn sold you an annuity product. And of course, once you pool of those risks, the people who live longer than expected are subsidised by the people who die sooner than expected. And that pooled risk basically ameliorated itself across the whole of society. Once you go into a individual drawdown proposition, you're not subject to those pooling facilities anymore. And so you're now self-insuring yourself against this longevity risk, and it's something you have to manage in the process. But before we get to how you might manage that, let's just take a quick look at what I mean about zoning in on spending. It won't be good enough to just look at what the client spends. You will need to spend some time analysing on what they spend their money. And I would recommend kind of like a Maslow's hierarchy of needs in terms of trying to help you understand on what the client is spending the money. And at the bottom of that is their kind of, we'll call it their heat and eat spending. So how much do they need to keep a roof over their heads, keep themselves warm, and keep food in their bellies and clothes on the back. Those basic living expenses will be kind of, they are the priority before you can even think about, okay, what are we going to spend on holidays this year? Shall we get ourselves a new car? These more leisure activities, eating out, going to the theatre, etc. You will have to take care of those basic living expenditures before you can then think about leisure activities and then more luxury items, the round the world cruise, the car that you've always wanted, go and buy yourself a boat, all of those things that we see on DFM brochures. And then finally, once you've taken care of all of that stuff, you can then start to think about what you're leaving as a legacy. Now, because you're going to have to spend time delving into the client's spending needs, they won't necessarily enjoy that process. They won't necessarily enjoy going through line by line their current account banking statements and trying to characterize all of their spending into these hierarchies. So one little tip I would give you is, if you think you have that influence over the client, have a think about nudging them towards some of the online banking applications, and maybe get them to use these sorts of facilities as their current account. Reason for that is these digital online banks will essentially do all this heavy lifting for you, because every single transaction will be digitally captured. And these apps often have the ability to help you characterize what you spent your money on. So instead of having one of your paraplanners trawling through a year's worth of your client accounts, if you can get these guys to start using the likes of Starling Bank, Mondo, etc., if you can get them to start using those sorts of applications, you'll save yourself a ton of work there. And it will just be a kind of nice, easy, downloadable format instead of trawling through line by line with the client in the client meeting, trying to analyze their spending patterns. Now, once you've got all of that information, you'll probably then go to cash flow forecasts. And most of your cash flow forecast tools that you'll be using, they will be making an assumption that, okay, well, let's run this policy on the basis that we'll take how much money you need right now, and we will adjust that spending need for some sort of inflation measure. Now, that's all fine and well, and actually it's quite a conservative assumption. And the reason it's a conservative assumption is not what happens in real life. And of course, if you've been advising clients who are in later life over a long period of time, you'll know that that's not what happens in later life. As people get later and later into life, as shown on this chart here, which is from the Office of National Statistics, as people get later and later into life, what they spend their money on, the mix of what they spend their money on changes significantly. And as they get into later life, on those items on which they spend their money always fall on pretty much every category expenditure, even all the way down to how much food and drink you're putting into your body. Appetites diminish as people get older, and so what they spend on food and drink will fall. Your desire to have, the latest, blazer or a jacket and that kind of stuff diminishes as you get into later life. What you spend on clothing for. So even the basic living expenditures, they tend to fall in later life. The single biggest transition as you go into later life is you spend less on transport, considerably less on transport. Main reason for that is you're no longer commuting to and from the office. And I appreciate no one is these days, but that gives you a good sense actually during COVID of how much money have you saved by not commuting on a day-to-day basis. Well, when you go into retirement, that's your life anyway. So you can see from this chart here, all of the cash flow tools which assume that your current spending at age 60, 65 will grow in line with inflation. It's a nice conservative assumption to have, but it's probably not consistent with what happens in real life. And therefore, if you are looking for cash flow tools and you're speaking to your cash flow tool provider, maybe ask them questions about, okay, well, how much can I play with this these spending assumptions so that it's a more realistic kind of portrayal of what will happen? Because what we do see all too often is the fear of running out of money means that people often don't spend enough, or they become very frugal in early retirement when they could actually enjoy spending their money, to the extent that they end up leaving a huge legacy to the next generation because they were just worried about a couple of things of, I might run out of money. They're probably overly worried about the probability of having to go into long-term healthcare plans. And they're also probably worried about the cost of those long-term health plans. Now, it's a travesty that you can't insure yourself against that risk within the UK. And the insurance market, I would argue, ought to do something about that. But people are arguably over-insuring themselves against that risk. And as a result, potentially leaving too much to the next generation, having a frugal retirement because they're worried about some of those risks. So there's some of the things that you want to consider when you're addressing things like your cash flow tools, which you would definitely want to have access to when you're putting your CRPs together. So back to these people, like I say, they are your customers, they're your clients, the people who will furnish your nests for not just today, for the rest of your careers, and it's a secular growth market. Now, these people probably started their accumulation journeys. If you look at current statistics, they probably started their accumulation journeys in their late 20s, early 30s, and early 30s is probably more likely. And therefore, when they get to the age of 60, 65, they've been investing and accumulating pension pots for around 25 to maybe 30 years. They're now going to decumulation, let's say at age 65. So life expectancy today at age 65 for females is 87. So you're expected to live for another 22 years, and there's a 5% chance that you'll reach age 100. And for men, it's at age 65, your life expectancy is another 20 years, and there's a 1 in 33 chance, 3% chance that you'll reach age 100. So your decumulation journey is probably going to be as long as your accumulation journey, and potentially even longer. And on your accumulation journey, so let's suppose you're retiring today, had you invested 30 years ago, started your accumulation journey, well, 30 years ago, we're talking 1990. Okay, you will have just missed the 1987 crash, but you've seen a couple of recessions along the way. You've seen the great financial crisis. You've seen dot-com boom and dot-com bust. You've seen 9/11. You've seen WorldCom, Enron, all of the financial frauds. You've seen just about every market condition there is, and the global pandemic. So we know over the next, if you saw that in the last 30 years, you can bet your life you're going to see similar sorts of circumstances going forward. And if you're leaving your money to the vagrancies of the market, you have to accept this as a long-term investment plan. And that long-term investment plan has to be embedded on day one. Otherwise, the fear that you might lose your money, and this is the pot of money that you have to live the rest of your life upon, seeing the vagrancies of the market will potentially make you panic. And so you need to build this investment solution which acknowledges that you will want access to investments, but also protects you against the ravages of inflation, and also calms the investors' nerves in terms of their ability to survive the ups and downs of markets over the next 30 years. Because the alternative is, well, I'll just take my pot of money, I'll stick it under the mattress, and we'll call this the mattress strategy. So let's suppose you had a pot of money, let's say it's £1 million client, so they've accumulated over the past 30 or so years a pension pot of £1 million. That's all of the money they have to live on for the rest of their lives. Now, you could legitimately put all of that, not I say metaphorically, under your mattress. You put that money under your mattress, and basically leaving it in a bank account these days is the financial equivalent, because you're earning no interest on it whatsoever. You put all that money under your mattress. You could legitimately take £100,000 worth of income out every single year, and provided you die in the next 10 years, that's a perfectly rational strategy to take. So you withdraw all of your money down, you've taken no investment risk whatsoever. In 10 years' time, you'll have no money left. But interestingly, the money that you're taking, so let's say you are taking £100,000 today, in 10 years' time at 2.5% inflation, that £100,000 will have the purchasing power of £78,000 in 10 years' time. Now, that's probably not a great strategy to take, because most people will live longer than 10 years in retirement. So let's play with the withdrawal rate a bit, and we want this pot to last longer. So let's take the withdrawal rate down to 5%. After 20 years of fail, and your money that you're taking today will be worth, every £1 will be worth 61 pence in the future. Now, 20 years probably doesn't cover you either. So you might want to nudge the withdrawal rate down again. Let's take it to 4%. Okay, well, if you're taking 4%, that's going to last for 25 years. But the money you're taking today will be worth roughly half that in 25 years' time. And then you might want to be super cautious and say, well, I absolutely don't want my money to ever run out. So I'm going to take the withdrawal rate down to 2%. 50 years to fail, I'll definitely not be here in 50 years' time. And therefore, okay, I'll operate on a 2% withdrawal rate. But as you can see, the ravages of inflation start to kick in here. And the money you're taking today is going to be worth about 30 pence in 50 years' time. So that mattress strategy probably doesn't work for you. You need your mattress to do something a bit more complicated than just simply store your money so that you can take it out of the pot. And the more complicated mattress strategy is, you're going to have to subject that investment pot to the vagaries of the financial markets. But importantly then, it's why I put that last column on, you cannot just put your money into bonds. Because if you're putting your money into bonds, they are nominal assets. They do not adjust for changes in inflation. And therefore, yes, it might give you the money. It might give you, your £10,000, £100,000 in 25, 50 years' time. But what you can do with that £10,000, £100,000 into the future will be significantly diminished by the ravages of inflation. And that's assuming, of course, that the Bank of England can maintain their CPI target of 2%, which equates to an RPI target of around 2.5%. So you have to have real assets in your portfolio. You have to have an investment strategy which allows the pot to grow, and you have to have investments within that investment strategy which can protect you against the ravages of inflation. So we're now into a world where we've introduced investment risk into the portfolio. And what I'm going to do here is just illustrate, using a 50-50 bond equity portfolio, the differences between an accumulation journey and a decumulation journey once you start to take money out of this. So let's go back into accumulation mode, and we'll take two portfolios here. We'll start one portfolio in 1906, 50-50 bond equity portfolio, and we'll start another portfolio in 1923. Again, 50-50 bond equity portfolio. We've chosen those start dates for a very particular reason, because if you start a 50-50 bond equity portfolio in the UK in 1906 or 1923, over the next 30 years, both of those portfolios will give you exactly the same annualized return of 5.5%, but also they will give you exactly the same annualized volatility. So if you are in your accumulation mode, you would consider these two portfolios to be identical in nature. And indeed, if you have a look at what happens over the next 30 years, they are identical in nature. From point A to point B, both of those portfolios give you exactly the same end result for someone who's in accumulation mode, and it starts with £100,000 with no withdrawals along the way. But in decumulation mode, your no withdrawals kind of stipulation on that portfolio drops away, and therefore you need to consider what happens when you start taking withdrawals from the pot. And this is what happens. So these are the exact same two portfolios. So our 1906 portfolio and our 1923 portfolio. But what we're going to do here is we're going to take 5% withdrawal every single year from this pot. And what you'll see there is the 1906 portfolio, which in the accumulation mode doesn't do anything for the first 10 years and then really starts to ramp up in the last 5 years of our 30-year journey. Because it doesn't start off well and you're withdrawing money from it, the pot rapidly starts to diminish. And even the investment returns, which come later on in the 30-year profile, because you've diminished the pot so much, those stellar investment returns later on in the investment period do not go in any way, shape, or form to make up for the fact that you've depleted the pot over the first 20 to 25 years. Contrast that with the portfolio starting in 1923, which gets off to a bit of a flyer in the first 10 to 15 years, and then kind of like starts to go sideways a little bit, has another bit of a run, and then goes nowhere for the last 5 or 10 years. Because of that profile where it gets off to a flyer, that basically getting off to a flyer allows you to fund the early years of retirement. And so you can take money out of that pot and actually leave a nice legacy for the next generation. Now, this is a 5% withdrawal rate. We can rerun all of this investment strategy, but instead of taking a 5% withdrawal rate, if we take a 4% withdrawal rate, you can see there that the 1906 portfolio actually gets into the territory of being able to recover from the withdrawals. So just a 1% difference, 5% withdrawal rate here, 4% withdrawal rate here. That 1% difference in the withdrawals allows for a significantly different experience at the end of it. But there's no way you would know what was going on. There's no way you'd be able to predict that 10 years into the investment journey. 10 years into the investment journey, if you start in 1906, and of course now we're into World War I, 10 years into that investment journey, you're now thinking, is my pot actually going to run out? Now, with a 4% withdrawal rate, it doesn't run out. With a 5% withdrawal rate, you're in real danger of the pot running out 30 years into the future. So the withdrawal rate is the single most important thing that you need to have when you're building your retirement propositions. The withdrawal rate is the single biggest determinant of being able to manage longevity risk. And so the most important thing is to establish a safe withdrawal rate. I'll let you all do your own research. 4% seems to be the rate at which indeed in all our studies, we could not find a portfolio of bonds and equities which ran out over 30 years with a withdrawal rate of 4%. But once you take that to 5%, about 1 in 10 portfolios ran out of money. And so 4% seems to be the magic number. That's backed up by other academic research, but I'll let you go and do your own research there. The investment strategy, though, has to be realistic and real. And what I mean by real is it has to hold real assets within it. And that's why it's really important not to, which is essentially what you do when you buy an annuity, you have to buy assets which have real returns baked within them. I would strongly recommend, going back to the cognitive stuff that we talked about before, that you write down the investment policy. Not just the investment policy, though, write down the withdrawal policy as well and put that into a statement. Something that people can, you and your client can refer back to when things, when markets are looking a bit risky, and they will at various points over the next 30 years. But also when your client's cognitive ability is perhaps impaired, by having something written down and signed by the client when they're in better mental health, that will help kind of anchor their expectations about what to expect in their portfolios. But as I say, over the next 30 years, you can bet your life you will see at least 5 and probably 7 bear markets. And that's the point when people will panic. And the single most important thing, and this is when you really add value as an advisor, it's holding the client's hand, getting them not to panic. You will probably have all lived through this in the past 12 months. you will have had clients coming to you in March saying, should I change my investment strategy? And we can say, as we sit here in February 2021, we can all sit here and say, it would have been the most fundamentally awful thing to do to change your investment strategy in March, April 2020. We can say that with the benefit of hindsight, but you will live through these periods into the future. The most important thing is that your client does not panic, and therefore, when you're building your investment strategy, which is what we'll go on to next, it's really important that you reduce the client's anxiety wherever possible. Now, one way you might think about doing that is going back to our spending patterns that we talked about before. You might legitimately want to say, okay, well, let's make sure that the client's basic spending needs are completely taken care of. Let's remove all longevity risk for the client's basic spending needs. And in which case, you might legitimately consider to go out and buy an annuity with part of the client's pension pot to cover their basic living expenses. Now, of course, they'll have a basic pension, basic state pension as well, which will supplement that. So you can rely on the basic state pension. You might want to top up their basic spending needs with a small annuity purchase, so that no matter what, the client knows that their basic spending needs are always going to be taken care of. Once you've got that out of the way, you can then start thinking about, okay, well, for your leisure and your luxury items, we can afford to take a little bit of risk with those, because they're not make or break on your life. And therefore, once we're into the realms of taking some investment risk with these sums on top of that, you still want the ability to reduce the client's anxiety. So I'm going to set up a kind of theoretical portfolio here, and we'll use some behavioral cues that you can build into your investment strategies in order to reduce the client's anxiety. Now, I want to get it on the table right here, right now. Statistically, the most valuable way that you could run a client's portfolio on a statistical basis is take as much equity risk as you can possibly afford to take, blindfold the client, get them never to look at their investment portfolio, set a safe withdrawal rate, and in most cases, in fact, every case, particularly with a safe withdrawal rate, the client will be absolutely fine. You should be taking equity risk in these portfolios, but the more equity risk you take, the more variability you will see in the client's portfolio on a day-to-day basis. And so I want to get out right here, right now, by bucketing this portfolio the way that we will discuss, it will reduce the overall expected return. But we're making a trade-off here. We are reducing the overall expected return in order to quell your client's anxiety. Because the worst thing you can do is load the client with equity risk, so much so that it breaches their risk tolerance. When the equity markets fall, as they did in March 2020, they panic, they change their investment portfolio, you will never recover from that. So I readily accept by bucketing the portfolio the way that we're about to discuss, it lowers the expected returns, but it increases the likelihood that your client will be able to survive the next 30 years in terms of their anxiety levels. Just important we put that out there. So what we're going to do here is we're going to bucket the client's portfolio into 3 buckets, consisting of a cash reserve, their defensive assets, and their growth assets. And we'll generically call a cash reserve just a bank deposit. Defensive assets will be a bond portfolio, and growth assets will be an equity portfolio. The reason we're doing this is in order to reduce the client's anxiety and allow them to take investment risk, we want to give them assurance that their next couple of years worth of income is already taken care of. And again, we've seen and spoken to lots of advisors in the past 12 months who have adopted strategies like this, which really, really helped in February, March, and April of 2020. Because yes, the markets were all over the place, but they were able to talk to their clients and say, don't worry about what's happened to the investment portfolio. We know that we've got the next 2 to 2.5 years worth of your income requirements completely taken care of at no risk whatsoever, all in this cash reserve. And that was a really effective tool for reducing clients' anxieties. Now, of course, that's a nice behavioral cue to build into your portfolio, But all it does, it kind of defers the original problem, which is, okay, well, if I run this strategy for 2.5 years and take a 4% income out of the portfolio, in 2.5 years, that cash reserve will have been depleted, and I'm back to the original problem that I had of sequence and risk. So the next thing you might want to do is, okay, well, how can we extend the life of that cash reserve? And the next thing you can do is you might want those portfolios, the risky assets in your portfolio, the bonds and the equities, if you can set them up so they produce a natural level of income, the natural income from these two elements of the portfolio can top up the cash reserves on an ongoing basis. So instead of just having 2 to 2.5 years worth of income visibility, in this basis, you've got around 15 years worth of income visibility, because it will be 15 years before, using this portfolio, the cash reserves fall below 1 year's worth of income requirements. It'll be 5 years before the cash level is less than 8%. And in most circumstances, we couldn't find a bond equity portfolio 50-50 split. We could not find a bond equity portfolio where you got a negative return over 5 years. That's not to say you won't see one in the future, but throughout history, and looking at over 100 years worth of data, we could not find a bond equity portfolio which give you a negative return over 5 years. Now, this portfolio will last for 15 years before the cash levels fall below 4%. And so we think putting the bucketing strategy with natural income generation really gives you the flexibility to run risk within your portfolio and allow the markets to do their work over 1, 2, and even 3 investment cycles. But as I said before, you will definitely see 6 or 7 bear markets over the next 30 years. The corollary of that, of course, is you will also see 6 or 7 bull markets over the next 30 years. And so another thing you might want to do is build in a smart rebalancing process into your investment strategy. So if we know that we will see 6 or 7 bear markets, like I say, you will definitely see 6 or 7 bull markets. And so if you can set a trigger so that when we see the bull markets, that we rebalance the portfolio and take our profits, if you can build that into the process as well through a smart rebalancing trigger within the portfolios, you can actually make the cash reserves last even longer than the 15 years that I referred to before. And so you put all of these strategies together, a bucketing strategy, a natural income strategy, and a smart rebalancing strategy. We can, and we can demonstrate this through our back tests. We can see that all of these portfolios will last 30 years and safely allow you to take 4% income indexed for inflation, which, as I said before, is a conservative assumption. We can show that these portfolios will last in excess of 30 years in all circumstances with a 4% withdrawal rate. So you start to pull all this together. Of course, you want to put this in your SIP, ISA, GIA kind of wrappers. And if that indeed is the case, and I'm going to go into advertorial mode here, you can build that portfolio to suit your own needs. This is a kind of generic portfolio. We actually have built one of these portfolios that you can get access to off the shelf immediately. If you were to change the defensive assets into the Eligible Income Funds, which is a bond fund which produces a 4% natural income, and you use the Eligible Income and Growth Fund for your growth assets, which is a equity portfolio, again designed to produce a 4% natural income over the course of the cycle, you use them as the component parts. That's our retirement portfolio service. So you put all of that together. Our retirement portfolio service is a portfolio, a managed portfolio service, so an MPS, where we do all of the smart rebalancing for you. We use our income funds, our income and growth funds, and we set the cash bucket in your portfolio. We manage that on a discretionary basis, on an ongoing basis. Now, the management of that portfolio is free of charge. There is zero cost for the retirement portfolio service. The reason we're able to do that, of course, is the strategies within the retirement portfolio service are our own income funds, are our own income and growth funds, where we charge 0.15%. But managing the MPS and the retirement portfolio service on our platform is completely free of charge. Now, of course, Feel free to build your own portfolios and choose your own inputs and manage these portfolios, maybe along the lines that we've talked about today. All I've hopefully done today is give you an idea of why you might want a centralised retirement proposition, some of the practical implementation of your cash flow tools, withdrawal policy statements, investment policy statements, and then we've built a generic investment strategy. But having seen all of this, you think it makes some sense, and you'd like a off-the-shelf, ready-to-go version of all of that. It's something we are able to do at AJ Bell, and if it is something you're interested in, just reach out to your local BDM or BDC, and they'll happily talk you through it. Hope that's been useful. That's my 45 minutes, and thank you very much.